Hi guys, welcome to Investing with JYK, and today we'll continue the basic investing series, and we are now on to the second statement in the financial statements, which is balance sheets. Balance sheets is a snapshot of the financial situation of that company. So it is accurate as of a particular date. So we'll go through each line item and I'll discuss the meaning. Right, so again, we'll rely on Walmart as an example. Right, so this is what it looks like. And let's just go back to here. So, okay, so first line is cash. Well, cash is the simplest to understand. It's just cash. And sometimes you would see short-term investments as well. So typically short-term investments are CDs or sometimes commercial paper or whatever, or money market funds or whatever that the company sees fit to use to allocate their excess cash. Typically, people treat short-term investments as cash. And okay, so the important thing about cash cannot be overstated. You need cash to pay bills. You cannot use other things to pay bills. Right, so that's cash. And in here you can see it says cash and cash equivalents. Cash equivalent is in this case probably some kind of commercial paper or whatnot. And then you have receivables. We've talked about receivables in a previous video when we talked about revenue. So just to recap, when you recognize revenue, that basically means a sale has happened. So as soon as a sale happens, first the amount of sale, that revenue, would immediately get transferred into receivables. And when that money, that cash, is collected from the client, at that point the receivables go down, and that amount, the same amount, get transferred into cash. Okay, so the important thing to watch is days sale outstanding. So that is basically receivables divided by trailing 12-month revenue divided by 365. So what does that mean? So revenue, trailing 12 months revenue divided by 365 is the average daily revenue. And then you do the receivable divided by the average daily revenue. That means how many days of a revenue is in your receivables. So for a lot of companies, they would range between like 30 and 60, especially if those are B2Bs. So B2B companies typically have a credit term. So they would say, okay, I will collect, you should pay me. The bill is due, say, 60 days after the goods are delivered, or whatever day. So that depends on the two parties. In the extreme case, you would end up with 128 days, or in the case of government, it could be even longer. Now, obviously, the shorter DSO, the better. The reason is that even though you have these receivables on your balance sheet, you cannot use the receivables to pay your suppliers or creditors, right? You somehow need the cash. So in order to get that cash, you would then have to probably borrow from a bank, and you have to pay interest on that. So for the same amount of transaction, you need essentially a higher amount of asset. So you need more asset to generate the same amount of sales and profit, just simply because most of your asset is stuck in receivables. And the next thing is inventories. Inventories is quite simple to understand too. It's just the stuff that you want to sell. In terms of Walmart, it's all the stuff they have in their warehouses, on their shelves. So inventories, the one thing you want to look at is days inventory outstanding, sometimes also known as I forgot. There was another name for it, but I forgot what it was. So very similarly, it's inventories divided by the average daily cost of goods sold. Cost of goods sold is the cost of your revenue. Since inventory is accounted on the cost basis, so that basically tells you, how many average daily cost of sales are there in your inventory. And another way of understanding it is like, if I do not replenish my inventory and I sell at the same speed, how long, under some crazy situation, because you have to replenish it, but imagine you can sell at the same speed without replenishing your inventory. How long would that take for me to exhaust my inventory? So obviously the same thing, the shorter the better. That means you turn over inventory really quickly. Walmart is a prime example of that. They probably have one of the, if not the lowest, one of the lowest DIOs in the entire, I would say, among almost all companies. And the reason you want as little inventory as possible, but no less, is that first of all, it's the same problem with receivables. If you get all that capital stuck in your inventories, you can't use inventory to pay bills, right? So you need to turn that into cash. So if you were able to generate the same amount of cash, same amount of excess cash, profit or excess cash, then the less inventory, the better. So you basically have a more efficient operation. The other thing is inventories potentially can depreciate. So a prime example would be perishables. So if you have food, then after a while, especially like vegetables or strawberries, you leave them on the shelf for 3 days, they're dead. So that inventory will go to zero. So if you have a lot of inventories, then you run a high risk of having to write down your inventories. So food is just one example. Even clothing, a lot of that is like fashion associated, and then fashion changes, and people are willing to pay less for the same thing, and suddenly your inventory is no longer worth their cost, and you have to write it down. Okay, so that should be fairly straightforward too. And property and equipment, those are like long-term stuff. So in terms of Walmart, you got, oh, by the way, these first three, cash, receivables, inventory, are the majority of what's known as current assets. So things that are easily liquidatable, liquidatable as in turning into cash. Things that can be easily be turned into cash are accounted for as current assets. And property equipment are the things that you intend to keep for quite a while, and you use those to move inventories, to store inventory or whatever in case of Walmart. And so what will happen to those is they will depreciate. If you buy a a warehouse, that structure will eventually wear down, so that there's a depreciation aspect there, and you have to maintain them, so there's a maintenance expense there, and typically they're carried at on the books at cost minus depreciation. So depreciation schedule is set by the company, depending on the thing, it would depreciate at different rates. So a building may depreciate in 30 years, but a computer may depreciate in just 3. And so yeah. Intangibles. So this is quite messy, but generally it's some kind of rights. So a lot of times, like spectral usage rights for, say, T-Mobile or something, those are intangibles because they're not an actual thing. Depending on the accounting standards, the intangibles can vary quite a bit. At least in Chinese accounting standard, land usage rights and for example, the toll roads, the toll collection right, these are all intangibles. And in US, I think the other source of intangibles is patent. Once you file a patent, the cost of that patent filing goes into intangibles, but it's a very stupid measure because the patent is usually either worth nothing or worth a lot more than what they paid for filing that patent. So it's kind of a stupid thing, but it's what we got. And then the next thing is goodwill, and it's basically bullshit. Goodwill is how much you overpaid for the net asset of a company that you purchased. So if company A bought company B, and company B has a net asset of, say, $1 million, and company A paid $2 million for company B, then after the business combination, all the company B's asset will go into each of those lines. Their cash goes into your cash. Their receivables goes into company A's receivables. Their inventory goes into company A's inventory, and same goes for property and equipment and intangibles and all that. But there's a difference of $1 million. So what does that do? What happens to that? That goes into this line, goodwill. So different accounting standards again treat this differently. In US, it used to be the case that you have to depreciate goodwill over a period of time. I forgot exactly how long, but that's no longer the case. And for a lot of companies, you can see majority of their balance sheet, their asset is made up with goodwill. For example, Teva or say even GE, a lot of goodwill on their balance sheet. And the thing is, will you be able to recoup that goodwill when you sell this company? Sell it out? If you do, ever, there's no guarantee. You never know. And in fact, it would change so much, it is basically pointless. It's a plug variable. So in US, you would have to reduce goodwill if the company that you bought did not perform as well as you wished, as you thought it would. But I don't exactly know if there's a strict rule on it, but that's what you're supposed to do. In China, typically it's written, so like if you expect the company that you bought to produce a certain amount of revenue, certain amount of profit, and then typically within 3 years. So there's a 3-year window, and then if they fail to perform, then you write down the goodwill accordingly. But my suggestion would be, don't pay any attention to goodwill. So if you take out intangibles and goodwill, these are called tangible assets. Right? So we're currently looking at the asset part of the balance sheet. So we're looking at all these here. And then just to recap, these 3 are the majority of your short-term assets, they're called current assets, and this thing is your long-term asset, and these are intangibles, and those four are also known as tangible asset. So there are some other lines, but it's not very important, and then usually they're not very large. And one thing that you notice that for Walmart, cash, receivables are both fairly small, and then they have some prepaid expenses, and inventory is somewhat high. Majority of their current assets made up with inventories, which makes sense. They are a retailer. They shouldn't have that much receivables because you pay as soon as you get the stuff. And their majority of their long-term asset is property and equipment. So that's that. And then you have this. This is a recent change, by the way. This is property under capital lease. So basically, even though they don't own the thing, for example, the building that Walmart resides in, sometimes they don't own it. They have a long-term lease, but you substantially benefit from it. You derive ownership-like benefits from it, and then under the new accounting rule, you have to account it as your asset, and on the other side, here, you also account for the same thing as a liability. So overall, there's no change in the net number, but the change is that you have higher asset and higher liabilities. So your financial, your debt ratio, for example, your debt ratio will go up because these behave like debts, right? Because you sign a contract saying that you're gonna lease this thing for like 99 years, and if you don't, hold on to it for 99 years, you have to pay some crazy penalty typically. So they usually, instead of terminating the lease, they will sublease it. Okay, so that's the asset part, and now let's get into the liabilities part. So liabilities, you got short-term borrowings, typically commercial paper or some ultra-short bond, whatever. So something that has an interest or the equivalent of an interest. And accounts payable are basically the money that you owe to your suppliers. It's the mirror image of accounts receivable. Accounts payable, basically you get your supplier's stuff, and then the supplier says, okay, pay me in 60 days, and that goes into accounts payable. As soon as you pay that, obviously cash goes down and accounts payable goes down. And accrued liabilities, this can be a lot of things, and it will be very different for each company. You have to look at each company's explanation for exactly what is in accrued liabilities. So, for example, for Walmart, you can see accrued liabilities here. That's what they have. So they have some wages they haven't yet paid, because wages get paid once every half a month or something. So, and then you have self-insurance. So basically, Walmart is large enough, so they say, okay, I'm gonna set up some reserves as self-insurance. These will be the amount of loss that I expect to sustain. And then some taxes that they have to pay. And then here are some deferred gift card revenue. So what that means is, if you buy a Walmart gift card, cash goes into Walmart's balance sheet, right? Because you just paid for the gift card. But the thing is, now they have accrued liability because they, in the future, they are obliged to give you stuff that's worth the same amount as the gift card. So, you know, if you sell gift card of your own company, you don't just get to increase your cash without the appropriate appropriate increase in the liability as well. And then even in accrued liabilities, you have this other thing which they kind of explain, like maintenance, utilities, and whatnot. But typically these won't be very alarming. And if you look at their balance sheet, where is their balance sheet? Go. Yeah, accrued liabilities, it's like half the size of accounts payable, and that's the majority of Walmart's. This is called the current liabilities. So that's the mirror image of current assets. And if you compare accounts payable to inventory, they're almost the same. So yeah. And the next thing is the current portion of long-term debt. That's quite simple. It's basically if you owe some money to somebody, and there's a payment schedule. Either it's the interest that you have to pay each month or year or something, and then during the period, it's like at the point when the balance sheet is taken, the interest is actually accruing, even though you are not paying it yet in cash. The liability is increasing as time goes by. So that is the interest part. And also the other thing is within a year, so anything that is coming due within a year also goes into here. So imagine if I borrow like $80 million and it's coming due within 11 months, that would go into the current portion of long-term debt. Capital lease, same thing. Capital lease obligation it's basically the mirror image of, it's to counter this property under capital lease asset line. So I think if you add this guy should be exactly the same as this line plus this line. There is a slight mismatch. I'm probably missing something. Maybe something is inside the let's see. Maybe there's something that's missing inside here. Some current assets, but they should match. Long-term debt, very simple. Anything that has a longer duration than 1 year is considered long-term debt. Long-term lease, again, same thing as like short-term. It's basically just capital lease, and it is anything that's not due in a year, right? So if you lease something for 99 years, the first year payment goes into current portion of capital lease, and the rest of the 98 years goes into the long-term lease part. So these things here, these 5 lines, are the majority of current liabilities. So things that you have to pay within a year, current liabilities. And then these are long-term liabilities, things that you have to pay within, after at least a year. So that's the liability side of the balance sheet. Now we get to the equity side. equity side is here. Oh, obviously I missed out some of the lines. For example, these like deferred income taxes, but basically this is just income taxes you have to pay at some point. And now the last part is equities. So here, okay, so we got common stock. It's quite simple. It's basically how much money that people, the investors, has paid into this company, the initial investors, or whenever the company sells new shares. And they would say something like 1 cent per share and whatnot, right here, common stock. You can see the number is really small, but it's pointless. It's just a figurative of speech. Like even though each share is supposed to be worth 1 cent, you can never get it back if the company goes bankrupt because you are so low under the capital structure, right? All the debt holders will, and preferred shares holders, they would take whatever is left of the company. The common stockholders usually have nothing left. So this is completely meaningless. And then it's just for ease of calculation. They just peg it at 1 cent, but actually when people invested in the company, they paid more than 1 cent per share. Right? And for example, if I paid $100 and the companies got split into 100 shares, each share should have been $1, but it's still counted as 1 share, and then the rest, you basically got 99 cents of this thing called capital in excess of par value, or sometimes known as contributed capital in another line. So this guy here, and that's essentially just a plug value between 1 cent times number of shares and the actual amount of money that investors gave the company across all ages. And the next line is the most confusing of all, retained earnings. Okay, so I typed it twice. I intended to type it 3 times. These are not cash sitting in somewhere. Remember, cash is on the asset side of the balance sheet. Retained earnings is just a plug variable. It is the difference between net asset and total contributed capital. Net asset is basically all the assets minus all the liabilities, right? So that is, on paper, how much money is the company worth. And then because the company has made money in its life, it now has more net asset than was initially put in it. And the difference between those two is called retained earnings. Okay, it's just a plug variable. Don't think there's a hoard of cash somewhere. It does not exist. And if the company has if the company has made a cumulative loss in its life, for example, Tesla, then this line would be known as accumulated deficit. And the last thing is there are 2 more, but this thing is again a plug variable. So now we have come across like 3-4 plug variables. They don't really mean much. Essentially, there are certain things that don't get reflected in the income statement, and basically because the transaction either did not fully close. For example, you have some kind of hedging thing going on, and then you did not put that in the income statement. Sometimes you do, like for like an insurance company and whatnot, they do, because that is meaningful to judge the healthiness of the health of the business, the core business, insurance business. But for Walmart, a lot of time it's like currency changes, right? So when the currency exchange rate changes, even though say Walmart Mexico made the same amount of money last year compared to the year 2 years compared to 2 years ago, because US dollar appreciated, the Mexican peso denominated assets suddenly are worth less. The Mexican peso denominated income is suddenly worth less, so that comes in here. And then a bunch of other things, like say if you have a pension fund, then if the pension fund is underfunded, then you have a comprehensive loss. If the pension fund is overfunded, then you have a comprehensive income, stuff like that. But usually, this line should be fairly small. If it's really large, then you really have to look into it. But if you want to look into it, you can definitely search for notes. So that's the other thing. Always look for notes. All right, so here we go. Maybe reclassify blah 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 to retain earnings. So there's some stuff here that talks about it, but generally it's not very interesting though. And then you got this thing called non-controlling interest. This really isn't that useful, but because we as shareholders only care about this line, total shareholders' equity. That is basically the net asset value that belongs to the shareholders. Non-controlling interest is basically some stuff that for example, they had a joint venture with some other company that Walmart actually controls. So this is I think that's what it is. I have to make sure I understood it correctly. I will double check, but I think it's when Walmart controls the joint venture by either holding more than 50% of the equity or some other rule. But the other partner, so the partner in that joint venture also owns a bit of equity in that joint venture. So you have to, so this is the partner's ownership, all their partners' ownership in anything that they don't control. Okay, so this is all there is with balance sheet, and hopefully this has been useful. I will double check on the non-controlling interest line. I think I'm correct, but I'll make sure that I got it correct. And yeah, if you like it, please click like. If you recommend this to your friends. If you want to do some further reading, I'll put the links to the books that I used to come up with a lot of this material in the description. Feel free to buy them on Amazon. I get a small cut, actually. Money's good. Greed is good. See you next time.